Hey there, happy Tuesday. So we've got the Home Builders Association giving us their confidence level going forward. We're going to dive into that today. Welcome to SRT Live with me, your host, Sean Richard. Thanks so much for joining me on this fantastic May 17th. And we've got some really interesting information to dive into today. The National Association of Home Builders came out with their market index. And then we actually had Jerome Powell speaking at a conference today. We got his remarks about an hour ago. So we'll touch on that a little bit. But as always, let's get into the economic news of the week and the week that was last week. So last week, we had a super impactful week. We had a lot of inflation data come out. I did talk about CPI, Consumer Price Index, last week. Just to kind of recap those numbers, we got the month over month and the year over year numbers. The headline numbers, month over month, the expectation was an increase of 2% or 0.2%. We actually came in a little bit hotter than expectation at 0.3%. And so that contributed to a hotter than expected year over year number. The consensus, the market was expecting 8.1% increase. This is down from 8.5. We actually got right in the middle, 8.3% year over year inflationary increase. So we did see inflation decline a little bit, but we didn't see a decline to the level of expectations. So inflation's still running hot. And then we got PPI, which is Producer Price Index. So quick clarification, we have CPI, Consumer Price Index. This is inflation at the consumer level. You go to the store, you buy products and services, inflation at that level. Producer Price Index is wholesale inflation. So the cost to make goods and get them to market. And the reason that it's important to differentiate between Consumer Price Index and Producer Price Index is because not all inflation at the producer level is passed on to the consumer level. And the numbers reflect that. So you heard me say that year over year, Consumer Price Index was 8.3% inflation. Now, Producer Price Index year over year was at 11%. Now this is compared to 10.7 expected. So definitely hotter than expected. But we've got a gap between Producer Price Index and Consumer Price Index. And that's where producers are not passing the additional inflation on to the consumers. And they can do that in a number of ways. They can increase their product costs. They can increase their prices, not cost, but increase their prices at market. They can reduce their cost to produce the same level of goods for a lower cost, or they can increase their efficiency. They can use their same resources to produce more product, which lowers their cost and helps offset what they have to pass on to the consumer. So year over year, PPI, Producer Price Index, was up 11%. Month over month, it was up 0.5%, right in line with expectations. So inflation is still running really, really hot, well above the target rate for the Fed, which the Fed wants to see that at 2%. And it's been a while since we've been there. All right. As always, last Thursday, we got jobless claims. So we got initial and continuing claims. So initial, people filing for unemployment for the first time. The expectation is we were going to get 195,000 new filings. We ended up at 203, so a little bit higher, but still running at very low levels. Again, speaking to the fact that the employment market, the labor market, is still very, very strong. And then continuing claims, which is individuals renewing their unemployment claims, fell a little bit. The expectation was 1.38 million, and it actually dropped to 1.34 million. So we saw a decline in continuing claims. Again, speaking to the strong labor market. So that was last week. Looking at yesterday and today. Yesterday, not much on the economic front, but today we did get the NAHB, which is the National Association of Home Builders. We got their housing market index. And this is basically builder confidence. This is a scale of 0 to 100 that indicates builder confidence. If numbers above 50 indicate that builders believe that the housing market will be expanding, high confidence, and numbers below 50 would indicate that builders are expecting the market to contract, the housing market to contract going forward. And so you're going to hear a lot about this number if you haven't already in the news, because it came in at 69. Now, in general, 69 would be a strong number. It's above 50. It represents confidence in expansion, but we have been running extremely hot on builder confidence. This is in contrast to the previous reading of 77. We had an 8-point drop in the NAHB Builder Housing Market Index. And so the media is going to say, oh, that's cooling off a little bit, and that's showing weakness in the housing market. And I couldn't disagree more. And I'm going to dive into that here in just a minute. So it is a little bit cooler, but we'll go into those reasons. Quick look ahead to the rest of this week. Tomorrow, we've got some housing data coming out. We've got housing starts, and we've got building permits. And this gives us a glimpse into the future on future sales. What homes are, what's the building status? How many starts are happening? How many permits are being pulled? It gives us a really good idea of what construction is looking like going forward. And then, as usual, on Thursday, we get the unemployment claims or jobless claims. We also get existing home sales on Thursday as well. So that'll be an interesting one for us to watch. All right, so let's talk about the National Association of Home Builders Market Index. And let's break it down. So ultimately, we went from a reading of 77, very optimistic on expansion going forward, and we fell to a level of 69. So again, the media is touting that as, oh, we've got a cooling in the housing market. The outlook is not as optimistic or robust as it has been over the past, let's call it 6 months to a year. And so what I want to do for you is I want to break that down a little bit and give you some talking points that you can take out to clients, to, if you're a real estate agent, that you can talk to your clients about. If you're a home buyer, I want to give you some education about what components go into that, what builders may be looking at, and what's influencing the builders to maybe say, okay, well, maybe we're not expecting as much expansion. So some of the key factors that the builders may be taking into consideration when they're looking at that optimism on expansion is, first off, material costs and or shortages. So material costs have risen dramatically. I think we all know that there's supply chain issues across all markets, all industries practically. And so the cost to obtain material and the shortage to obtain, the inability to maintain or to obtain those materials in a timely fashion make it more challenging for builders to put up homes quickly. We're at a severe supply glut in the new home space. You've maybe seen some of the charts I put up before from 2000 to 2009. Across the entire country, we put up a little bit over 20 million homes. From 2010, let's go this way, 2010 to 2019, we put up a little bit over 5 million homes. Quite a dramatic dip on the number of new homes being built over that time frame. And so we're having to play catch up in new build supply, and material costs and shortages are causing an issue with builders being able to put up homes quick enough. The second factor that may be playing a role in that is labor costs and shortages. So we've got labor costs going up for builders as well. You have a reduction or a shortage of skilled labor. So many builders are trying to put up homes, and so the labor is being spread thin. It's costing builders more to get crews out on job sites, and you've got shortages in the labor market as well for those, for slowing down the builders' ability to put up homes. And so that could be contributing toward their maybe less optimistic outlook. Next, we've got interest rates on the rise for the past 120 days, 150 days, and that is likely to some degree reducing the buyer pool that's out there. If you're a builder and interest rates go from 3% to 5.5%, then there's going to be a portion of the population that either no longer qualifies for the price point that you're at, or you may have a portion of the population say, you know what, we're going to sit tight for right now, and we're going to wait to see what happens. And so the rising interest rates potentially reduce the buyer pool, which is going to impact the traffic walking into the builders' offices. You have overall inflation or next up, you have overall inflation causing a similar reaction. And so with everything across the board, everything from grocery items to services to gas, everything across the board has been impacted by inflation. And so that has consumers taking a look at where they want to spend their money and whether or not they want to make a large purchase right now. Does it make sense if a lot more of your income is going out for all of your necessities? Does it make sense to spend more money and go make a large purchase on a new home? Some people may think that it's not the wisest decision for them. And others may say, you know what, I'm okay with that. I'm still going to buy. But it has the potential to also reduce the buyer pool, impacting walking traffic to the builders. Next, we have what's going on in the stock market. So if you're invested in the stock market in any way, you've likely seen some declines lately across the broader markets. We've seen the market come down. And what that's doing is that's reducing the asset balances of a lot of people that are in the market. Now, this doesn't apply to everyone, but if you see your investment portfolio drop by 20% over the course of a month, 2 months, and your asset balances are now much lower than they were, again, some people may find that as a reason to feel less confident about going out and making a major purchase like a new home, especially with some of those other factors that I talked about. So the reduction in the stock market may be impacting the buyer pool as well. May cause potential buyers to simply opt out of buying at the moment. So those are 5 critical components that may be impacting the builder's sentiment on this month's NAHB housing index. So let's keep an eye on that next month to see if that bounces back or if we see a further reduction in that sentiment. But as of right now, that reading is still 69, still optimistic about expansion, just not quite as confident as they have been in recent months. All right, so let's turn. Last topic of the day, we're going to talk about Jerome Powell, JPow, our favorite guy in the Fed. Fed Chair Jerome Powell came out at a conference, had some comments, talked about the economy. And so the main takeaway, and I'm paraphrasing here, is that curbing inflation will not be easy. And there may be some economic pain in trying to get inflation in line. Now, I said it a minute ago, but the Fed's target inflation rate is all the way down at 2%. And you heard me mention CPI most recently was running at 8.3. Now, CPI is not the Fed's favorite measure of inflation. They prefer PCE, which is personal consumption expenditure. Personal consumption expenditure does not take into consideration housing. So it doesn't take into consideration the major increases that we've seen in housing and rents. But that's the Fed's favorite metric for inflation. And so getting that back down to 2% is going to be their priority going forward. And Fed Chair Powell stated that they can't promise a soft landing. And what that means in Fed speak is they can't promise that we won't be in a recession. He did indicate that there were some paths to make that happen, but it's definitely going to be challenging to avoid a recession. But again, there are pathways to get there. And their focus, as I mentioned, is to get inflation back down to that 2% mark. So we can expect that we're likely going to see the Fed increase the Fed funds rate by another 0.5% at their June meeting. And we may even see another 0.5% at the following meeting after that. So that's something that we need to keep an eye on. And if you're a consumer, if you're a homeowner, home buyer watching this, the good news is that's not going to negatively impact the mortgage interest rates. Again, the Fed funds rate is short-term overnight lending, and mortgage rates are long-term lending products. And by the Fed increasing the Fed funds rate, you are going to see an increase on some of your discretionary lending products like lines of credit, credit cards, maybe auto loans, things of that nature. But you're going to ultimately, the goal is for that increase in the Fed funds rate to bring inflation down, and ultimately that would likely take the pressure off of mortgage rates and bring them down a little bit as well. So have confidence as a home buyer that things are moving in the right direction, and because of the supply and demand dynamic, we're likely to see home prices continue to rise at a healthy pace for the next several years in the foreseeable future. And with some of the buyers opting out of this market, it may be the best time to go ahead and buy to get that appreciation in that value in the coming years. So if you have any questions whatsoever, I want you to reach out to me. There's my number right there. Feel free to leave comments below and be happy to answer your questions. But thank you everyone for joining me on this episode of SRT Live and your weekly real estate update. Have an incredible rest of your week. Take care.